Hi, this is Steve Rothman from Rothman and Company, and this is another in our series of talks that are intended for startup companies and their investors, especially startups coming out of universities, but not only, and in fact this particular one is going to be of interest to more broadly than that. We're going to be talking about equity compensation plans in LLCs, limited liability companies, which is something that a lot of people get confused about. So basically we're dealing with a situation in which a business has been set up as a limited liability company rather than a corporation, and I'll briefly talk about the difference of what those, the difference between the two, although we're going to have a whole video on choice of entity, so I'm not going to go into all the details about that. But assuming that you've decided to use an LLC, or that somebody who's hiring you has decided to use an LLC, because this video should also be of interest to people who are being offered a job with an LLC and are being offered some type of equity interest and don't quite understand it because it's not exactly like a stock option in a corporation, although as you're going to find out it really is pretty much like one. You've set up a business as an LLC, and we want to grant ownership interests to employees as compensation and as an incentive to them to do a good job. And similar to what you would have in a corporation with a stock option plan, but that's not what we're going to use. I don't really recommend using option plans in limited liability companies for reasons that I'm going to explain. But instead something that's known as a profits interest plan. And I think this represents a majority view of lawyers who work in this area, but not a universal view, and so toward the end I'll touch on briefly some of the advantages and disadvantages and reasons why some people still like to use option plans even in an LLC setting. So first I do need to quickly cover what's a corporation and what's an LLC and the differences, otherwise the rest won't make sense. So corporation, most people are kind of familiar with. It's just an entity, usually a business entity, that has been set up that's separate from its owners, and that's the main purpose of it, is to be a legally separate entity from the owners, so that if things don't go well and it goes under the debts that the corporation has, they're not the personal responsibility of the owners. So the creditors, people who are owed money, they can come take the assets of the corporation to get paid, but they can't come take the house of the founder. That's kind of the main difference. There's other functions of a corporation. It gives you a way of holding assets in a single entity. If you have a bunch of patents, if you were doing business with a group of people and you didn't have a single entity, well, which one of them is going to own the title to the patents and things like that. So there's other reasons to have a corporation. They can have an unlimited life, whereas unfortunately most of us don't have an unlimited life, so it helps with just transitions and that kind of thing. There's lots of reasons to have a corporation. And the ownership interests in a corporation are known as stock. Everybody knows that. You get shares of stock, and you can calculate, if you have a single class of stock, common stock, and you can just calculate what percentage interest in the corporation you have based on the number of shares that you own versus how many are outstanding. There can be lots more fancy ways of doing things that we're not going to talk about today, with different classes of stock, convertible preferred stocks, things like that. But basically the ownership interests are called stock, and I only mention that because they're not called stock usually in an LLC. LLC ownership interests are usually referred to as membership interests or membership units or just as units, and it can get a little confusing, at least to me, when people talk about stock in an LLC, because there isn't stock. Okay, so the important distinction then, or an important distinction to make between a corporation and an LLC, is in the tax treatment. So a corporation, here I'm talking about C corporations. There's two kinds. There's C corporations and S corporations. When I say corporation here, I'm going to be just talking about the C corporations for now. They pay taxes at the corporate rate. So at the end of the year, they report income or loss, and if they have income, they pay tax on that income. The corporation itself pays the tax, and it's at a rate that's specified. I'm talking from the U.S. here, and I'm talking about federal law, so it's a rate specified in the Internal Revenue Code. There is a gradated system where the percentage goes up based on how much income there was, but I think the average rate now is 34%, speaking in 2013. So that's how corporate tax works. Corporate tax is a pretty complicated topic, but that's a very, very basic. If it has losses, the losses sit there in the corporation. They can get carried forward to use in future years if there's gain, and in some cases they can get carried back, and there's a lot of detailed law on that too that I'm not going to go into here. It's way beyond the scope, but that's the basics of corporation tax. And the difference with an LLC is that an LLC is usually treated as a pass-through entity, like a partnership. And the way a partnership is taxed is as follows. It's going to report its income to the federal government just like a corporation was, but then the partnership itself doesn't owe any tax on the income, and it doesn't get deductions itself for the loss. It allocates the income and the loss to the partners. And so if you have a simple 50-50 partnership and it makes $100, it reports to the IRS $100 net income now, I'm assuming, and each partner would have an allocation of $50 of that net income, which the partnership would report to the IRS and also to the partners, and then each of the partners would have to pay tax on their share of that $50. And that's true whether or not the partnership actually distributed out the $50 to the owners or not. So you can see why it's called a pass-through entity. The tax attributes pass through from the entity to the individual owners. And that's how LLCs are normally set up. Actually, LLCs you can elect to be taxed as a corporation if you want, but nobody does that pretty much. If you want to be taxed as a corporation, you'd usually just set up a corporation. So, first thing to note about LLCs that's different is that they're pass-throughs. Second thing to note that's different is that they have these things that are called capital accounts, and again they're like partnerships this way. So if you're a shareholder in a corporation, and again if it's a kind of simple corporation, one class of stock, you either own the stock or you don't, and you have a certain number of shares and that's it, and that's kind of all you need to know about your economic position in the corporation. Maybe what you paid for it is important to you, but that's all there is to know. Partnerships and LLCs are more complicated. We have really two attributes that are significant. The first is your capital account, and then the second is your percentage interest. And the capital account, typically, the way it works is it starts out as however much money you invested. So if you're a founder in a company and you haven't invested any cash and you've gone out and you've raised money from investors, you have a zero capital account at the beginning of time, and then they have a capital account that equals the amount of money that they invested. And then those capital accounts are used over time to track everything that's important, at least from a tax perspective, about the LLC. So if someone puts more money in, their capital account goes up. If someone takes money out, their capital account goes down. You have a percentage interest as well as a capital account, and it's usually the same percentage of income and loss. It doesn't really have to be, but so let's say you have 3 members in an LLC and they share the income and loss a third, and in a particular year there is some income, then a third of that income would get allocated to your capital account. So your capital account can go up if you put cash in, and it can go up if you get profits allocated to it. It can go down if you take cash out, and you probably guessed it, it goes down if you get losses allocated to you. So if in a particular year the LLC has a loss, those losses get allocated to the members. the LLC agreement, or operating agreement it's sometimes called, will tell you what percentage and how they get allocated. But whatever your share is of the loss, that would get allocated to your capital account. So the capital account is kind of like a measure of where you are in terms of how much of the company that you own. And then those allocations from the LLC to its members, those are, as I said, reported to both the members and to the IRS by the company on a form that's called a K-1. And then the operating agreement will have some procedures in it that says what happens if you liquidate the company. And liquidate is a fancy way of saying sell. It usually refers to dividing up the company into its pieces and selling off all the assets, but very often a sale as a going concern as a whole is treated the same as a liquidation. And the LLC operating agreement will specify what the liquidation procedures are, and in most cases they're going to be that the members are going to get money up until they've been returned their capital account, whatever it is at the time of the liquidation, which may not be the same as when you started the company because they may have had profits allocated to it. So they're going to get their liquidation amount, they're going to get their capital account, and then after that, whatever money is left over is going to get allocated based on the percentage flow of profit and loss according to the agreement. Okay, so that's the basic difference between a corporation and an LLC. Now I want to touch very, very briefly on corporate stock option plans, only by way of contrast. Again, it's a topic you could spend a whole talk on easily, and there's different types of corporate stock options. There are what are called qualified incentive stock option plans that are taxed under Section 422 of the Internal Revenue Code, and there are so-called non-qualified option plans that are taxed under Section 83 of the Internal Revenue Code. And a lot of people think that the qualified incentive stock options are the good ones and the non-qualified are bad. I don't agree with that. I actually typically recommend that my clients use the non-qualified options, and again, that's a topic of a whole other video which I'm not going to go into here, but basically the reason is that while there's an advantage to the person holding the option of having an incentive stock option because they get capital, they may get capital gain treatment, which means lower tax than ordinary income, typically, under the current law at least, unless they change that. The corporation loses its deductions. So in a non-qualified option plan, if at the time of exercise of the option the employee has $100 of taxable income in its ordinary income, the company also has a deduction of $100, and it can use that loss to offset against other income. And so actually, if you look at the total amount of money going to the federal government from the company and its owners, it's a wash. Whereas with qualified option, there's no deduction to the company. So you're buying a reduction in the rate paid for by the employee by giving up completely the deduction that the company would have. So you're paying for 20% by giving up 100%. I'm not sure I got those numbers exactly right, but you get the idea. And there's usually a way to do it so that either both sides come out better, or one side comes out the same and the other side comes out better. So anyway, but there's different types of corporate stock option plans. The main thing about stock option plans from a practical standpoint is that people are familiar with them. Software engineers in Silicon Valley are familiar with them, and they know that there are people down the road who made a lot of money from stock options, and so they're comfortable with them. Now, what's wrong then with having a stock option plan in an LLC? Well, first of all, there's no stock. If you go back to what I said earlier, this is just terminology, but what the ownership interests are typically called in the different entities. Usually LLC ownership interests are referred to as membership interests or membership units. They could be called stock actually, but that's kind of unusual. But that's a semantic thing. the more significant differences are, first, that the tax treatment is uncertain. If you have an option to buy an ownership interest in an LLC, it's not 100% clear what the tax consequences of that are. There are regulations that were proposed by the Internal Revenue Service quite a number of years ago now that would govern that, and I think most lawyers assume that those apply, but they were never really adopted, so they're not legally binding. Whereas the other type of LLC compensation system that I'm going to talk about, the profits interest, there are two rulings by the Internal Revenue Service on them. There are things called revenue procedures, and I won't bore you with citing them, but you can write to me if you want to know the exact text, and you can look them up on the internet and read them. They're much shorter than the regulations that would have governed the option plans. But the difference is, when the IRS said that they were not going to, at this time, adopt the option plan regulations, they also said that means you can continue to rely on the old revenue procedures. So they're binding, they're real law. And so there's more clarity in how profits interest will be treated than in how options in an LLC setting will be treated. Okay, so what is a profits interest? And why would you want to use one? First is, there's no need to buy in. With an option, there's always an exercise price. It can be very low if you're in the original early stages of the company and the company's not worth much yet, but there's some option price that the grantee, the employee, has to pay to get the option. That's not true with a profits interest. With a profits interest, you're just granted a percentage interest in the profits of the company. Now, how's that different from being granted what's called a capital interest? You don't want to be granted a capital interest from a tax standpoint because it's taxable to you if you're granted a capital interest. So what's the difference? A profits interest means that if the company were liquidated the day after you received the interest, you would get zero. So you might be wondering, why do I want one if it's worth zero? Well, because what you're getting is not part of the current value of the company. You're getting a right to share in the future appreciation in value of the company. So if there are profits next year, you get your share of the profits. If in 5 years the company's sold at a big gain, you get your share of the gain. And if you stop and think about it for a minute, this is exactly what you get when you get a stock option in a corporation. A stock option in a corporation is not worth the same as a share of stock because it's got that exercise price associated with it. And so the exercise price under the tax law, if you want the grant of the option not to be taxable at the time of the grant, which is what you always want, you don't want your employees paying tax when they're getting grants of things that don't involve cash yet and there's no cash to pay the tax. So if you want an option grant not to be taxable at the time of the grant, then the option exercise price, talking about corporations now, the option exercise price has to be at least equal to the value of the stock that the employee is getting an option to purchase. So in effect, what's the employee really getting? If the company were liquidated the next day, they'd get nothing, right? Because they would have to pay the same thing that the stock's worth and then in order to get the stock. What they're getting is a right to the future appreciation. And that's a very valuable thing because all of us can get rights to future appreciation of a company's stock. You go out on the New York Stock Exchange and you buy some shares, and if it goes up, then you're going to get a profit. But you have to put in your money to do that. And the wonderful thing about stock options in the corporate setting or profits interest in the LLC setting is that you don't need to put your own money at risk. You just get to sit back and wait and see if it goes up, and if it goes up, you get your share of the profits. So that's basically what a profits interest is. A couple of things that are important to note about it. The first is that if you meet the requirements that they have in those revenue procedures that I talked about, then you're certain that what you get out of that profits interest is going to be capital gain rather than ordinary income. And as long as we still have a capital gain tax, that makes a big difference. The revenue procedures require you to have held your interest for 2 years as a condition for that. The normal capital gain holding period is shorter than that. It's not clear. It may well be that you could hold for a shorter period and actually get the capital gain treatment, but at least if you hold for 2 years and then the company's sold, you're sure you're going to get capital gain treatment. So mechanically, how does the company go about granting a profits interest? I said that it has to be the case that if the company was liquidated the next day, the employee would get nothing. Well, what they do is this. Remember I said everyone in an LLC has a capital account. And in your typical operating agreement, the agreement is going to say that if you liquidate or sell the LLC, first all the money goes to the people who have positive capital accounts in proportion to their capital, and then the rest gets split according to the percentage interests. So if the capital accounts of all the members added together were equal to the total value of the company, then all of the money would get distributed to the people with the capital accounts and there wouldn't be anything else left over. So what you do when you grant a profits interest is that you take all the capital accounts, and if they're not already equal to the value of the company, you make them equal to the value of the company by doing what's referred to as a gross up, assuming it should be going up rather than down. In other words, assuming the company is worth more than the total value of the capital accounts at that point, then you increase the capital accounts. How do you do it? You look at the percentage interest part of the operating agreement. So if we have a 50-50 partnership, and so you own half and I own half, and we both have capital accounts, but our capital accounts add to $5,000, and right now the company is worth $15,000. There's a $10,000 gain there. And so that would be allocated between you and me, 50-50, since that's what the agreement says. We'd each get another $5,000, and the capital accounts would be grossed up to where they were $15,000, and now the capital accounts in the aggregate are equal to the value of the company. And then the new person coming in, the one who is granted the profits interest, he starts with a zero capital account. So if you sold the company the next day, if it's worth $15,000, there's $15,000 in capital accounts, the money would all go to the people with the capital accounts, the new person would get nothing. But remember, he's getting his percentage interest, which is going to enable him to participate in his share in any increase that that company experiences in value over the $15,000, and also in any year-to-year profits that might get accrued or distributed out. So that's basically how profits interests work. What I recommend for companies that are set up as LLCs is that they use profits interest plans. So why doesn't everybody use them? First of all, they're not called stock options. And as I said at the beginning, stock options are very familiar, and a lot of employees who don't know, or at least didn't know until they watched this video, everything that I just described, if they're weighing a couple of jobs, and in one job the person says, well, we give stock options, and the other one says, well, we don't give stock options, but we give these other things that are called profits interest, and they're like stock options. Someone who's not too experienced with this may think that someone's trying to pull the wool over their eyes and they're getting something that's not of as much value. That's not the case. What's going to determine whether your equity grant is of value is whether the company is of value. It's not going to be whether it's an LLC, and it's not going to be, or versus a corporation, and it's not going to be whether you get a stock option versus whether you get a profits interest. There's nothing wrong with getting a profits interest. Second reason not everybody uses them is I described a little bit some of the mechanics, and the mechanics are a little less familiar, maybe more complicated, maybe not really more complicated, but at least less familiar than they are with stock options. So if you get a profits interest in an LLC, you become a member. And as a member, every year you're going to get this piece of paper in the mail from the company called a K-1. It's like getting another W-2. Except if you're talking about startup companies, especially in the early phases, that K-1 is always going to say the same thing on it. It's going to say that your share of the loss is 0. Because typically in the early years, companies have losses, not profits. And there are special IRS rules that are, again, beyond the scope for me to go into all the detail, but the point of them is to make sure that the phantom losses aren't being allocated. And what they say basically is that if the company has a loss and somebody has a 0 capital account, that person isn't allocated any of the LLC loss. It all gets allocated to the people with the positive capital accounts, because they're the ones that put the money in, they're the ones that are really losing the money, and so that's where the benefit of the tax deductions ought to go. So you're going to get a K-1, but it's not going to mean anything, because it's going to be a 0 on it. So don't worry about it. In later years, if the company becomes profitable but hasn't been sold yet, your K-1 is going to show your positive share of the company's profits. And some people would worry, wait a second, I'm going to have to pay my share of profits that the LLC made, but I don't have a guarantee that the LLC is actually distributing that money out to me, and I might have to pay tax when I don't have any cash to pay the tax. But it's for that reason that virtually every LLC agreement that I have ever seen in my life has a provision in it that requires the company, when it has positive taxable income, to pay out that portion of its profits, at least that portion of its profits that is necessary in order to give the people the cash they need to pay their taxes on the company income. They can pay out more than that if they want, but they got to pay out at least that amount. So, so you're going to get this K-1, but some people think, well, that's a little complicated. It's an extra piece of paper to give to an employee. It's like giving them another W-2, although W-2 is almost always bad news because it means you have to pay tax. The K-1 generally doesn't mean you have to pay tax because it's going to be 0 in the early years normally, and in the later years, if it's positive, that's good because that means there was a profit, and that under the operating agreement, a share of that profit will have been paid to you. But anyway, some people don't like it just because it's another piece of paper. You got to explain it. You got to have your employees watch this video so that they kind of understand what is going on. Okay, summarize, takeaway messages. If you are an employee and you're being offered a profits interest, just think stock option. It's the same beast. I mean, it's not from a technical standpoint. There's different treatment, but from an economic standpoint, it really is. What matters is what percentage interest of the company are you getting, and is the company going to succeed or not? Not is it a profits interest versus is it a stock option. Second takeaway, if you're the one that's starting the company, you're the founder, and you're trying to choose between entities, do I want to have a corporation? Do I want to have an LLC? Do I want to have an S corporation? I have a whole video on that. You can watch it. But the point I want to make here is that the choice should probably not, in my opinion, be driven primarily or even significantly by whether you can grant stock options. That is to say, whether you have a corporation and therefore can give stock options, or whether you have an LLC and therefore you're going to give profits interests. There's other reasons that are more significant that should affect your choice of entity. Generally speaking, venture capitalists tend to like having corporations for reasons beyond the scope here. Generally speaking, angel investors like to have LLCs. They get the benefit of the flow through of the tax deductions. So you should be talking to your potential investors about what form of entity they want and go with the flow. Both forms work. Okay, I hope that's been clear. My name's Steve Rothman. I'm with Rothman & Company. Have a great day and good luck with your venture.